How to earn money in sideways market. Make certain to also review what are stock options. Utilizing a brief strangle indicates you aren't relegated to the sidelines when the stock exchange isn't trending, or a stock you want isn't moving. Sideways markets present opportunities for astute investors, specifically when including options. Option techniques enable investors to potentially benefit from all sorts of trading conditions, including sideways markets if their prediction ends up being right. Below's just how to make use of the brief strangle options approach to profit from a sideways market. The options vendor obtains costs for both the call and place. If the cost stays between $38 as well as $42, called strike costs, in this instance, after that both alternatives end worthless, and also the short strangle seller gets to maintain the premium got. While losses can get large when holding a brief strangle setting, an option vendor can liquidate their setting at any time to lower damages. Similar to a quit loss can be positioned on a stock position, if the cost breaks over or is listed below $42 or $38 specifically, the seller can liquidate the option positions, giving up the premiums, as well as taking a tiny loss. For a trader with alternative strategy understanding, a sideways market can offer a chance. What's a short strangle? Why sideways markets are risky? Who should utilize the brief strangle? Dangers and rewards. The bottom line. What's a short strangle? A brief strangle alternatives technique is the synchronized selling of both a phone call as well as a put option. Both choices are sold out of the money, preferably a good distance far from the present underlying supply price. For instance, if a stock is stuck near $40 and hardly relocating, a put choice is sold at $38, and also a telephone call option sold at $42. These sideways times usually cause investors to question the fad. They get in and also exit placements, but the supply doesn't move. In other words, for the majority of investors, a sideways market is a terrifying place full of unpredictability, and also threat relying on which method the price at some point price breaks out, and also when that will happen. The short strangle is made to earn money during a sideways market. If the marketplace breaks out though, as well as steps above $42 or listed below $38, then the short strangle faces potentially huge losses relying on exactly how far the price runs. Why sideways markets are risky? Trending trading is where many traders position their emphasis since the fad gives a directional prejudice, as well as a lucrative edge. As long as the pattern persists, the investor earns money. Patterns can reverse though, or might come to a halt for a prolonged amount of times as the price moves sideways, moving within a band of resistance and resistance. See also 7 options trading mistakes beginners can prevent. If, at the October expiration, the cost is in between $16 as well as $13, the choice brief strangle vendor gets to maintain the $375. Who must use the brief strangle? It makes good sense to utilize a short strangle throughout times of reduced volatility or prospective low volatility. If you think a supply or various other assets is most likely to move sideways at the very least till the alternatives sold, a telephone call, and also a put, run out, then using this approach makes good sense. When the profit capacity is non-existent or very tiny in the underlying supply, it's a method to benefit even. Dangers and rewards. To comprehend the dangers, earnings capacity, as well as just how to implement a brief strangle below an actual instance using Star Financial as the underlying supply, and making use of end-of-day quotes for the options from the Chicago Board Options Exchange, CBOE.com. The high of the present variety is $15.19. For that reason, a telephone call could cost $16 over the high of the array. The reduction of the range is $13.79, therefore a put could be sold at $13 below the low of the array. Both the call and also the put are outside the present rate. As long as the price stays between $16 as well as $13, the trade will certainly be profitable. Or listed below $13, they encounter an approximate $500 loss for each buck the cost actions past these limits, if at the October expiry the rate is over $16. Remember, however, as an alternative vendor you can close out the setting any time. If the rate is bursting out of the array, it is feasible to reduce losses before expiry, and potentially also pocket a small portion of the costs before it is shed, or the loss comes to be bigger. The bottom line. The short strangle choices technique is utilized in sideways markets, as well as involves marketing an out-of-the-money phone call and put. The option seller obtains the costs for the choice sales, and if the price is between both strike prices at expiry, the trader keeps the premium. The danger is available in when the rate moves over or listed below the call or put strike cost specifically. This can lead to large losses. As a result, the method works in sideways markets, but doesn't fare well in trending markets. The brief strangle vendor can leave any time before expiry to lock in part of the costs or reduce their losses. Temporary traders can use the strategy, as well as longer-term investors. The longer the time till expiry, the higher the costs got, but that likewise leaves even more time for the trade to go sour. The much shorter the time till expiry, commonly the smaller the premium, but there is much less time for the profession to sour. There undoubtedly is a compromise right here. Because of the high danger if the underlying stock actions beyond either of the strike prices, this approach is suggested for innovative choices investors, or at minimal somebody that is really disciplined and qualified of cutting the loss on shedding professions extremely promptly. The premiums stand for the costs obtained for each and every share sold. Think the trader markets 500 shares worth of options on each the put and phone call. As an example, if the price is at $18 when the options end, the trader deals with a loss of $2 per share on the call choice. Holding 500 shares worth of call options, the seller is required to make great on this transaction, which requires serving $1,000. The trader got $375 at first, so the loss on the profession is $1,000 to $375 equals $625. When the alternative ends, the deals with a loss of $1 per share on the put alternative, if the price is at $12. Holding 500 shares worth of put options, the trader faces a loss of $500. $375 was obtained initially, so the real loss is $500 plus $375 equals $125. Numbers might differ somewhat based on the real market value of choices simply before expiry. The amount received equates to 500 times 50 cents equals $250 for the calls, and 500 times 25 cents equals $125 for the puts, for a total amount of $375, and much less payments.